Hey traders, and welcome back to another episode of Smart Risk. If you can't read market structure, you can't win in trading. It's that simple. This is the first and most important skill every trader must master, because it's the real key to consistent success and profitability. And that's exactly what we're covering today. I'm going to break down 4 essential hacks to mastering market structure, the ones most traders completely overlook, but every new trader must know and apply when sitting behind the charts. Plus, I'll share advanced market structure mapping tips that can put you one step ahead of the market and your competition. So, make sure you watch this video all the way through. We always appreciate your support, so please give this video a thumbs up and subscribe to our channel if you are new. See you after intro.
I don't ever slow up, no I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this, I'll always show.
Welcome back traders, so let's get started. The first and most important hack in market structure mapping is identifying the current price direction. In other words, figuring out whether the market is trending or consolidating. The market generally moves in 2 ways. In a trend, either upward or downward, or in a consolidation phase, moving sideways and building up liquidity. Price typically needs to consolidate between trend moves. Think of it like a continuous cycle where the market rotates between uptrends, downtrends, and range-bound phases that accumulate institutional orders and liquidity. So, the first thing to check when you open a chart is this. Is the market in an uptrend, a downtrend, or a sideways consolidation? Now, let's break down exactly how to determine that. In an uptrend, price consistently forms higher highs and higher lows. This means buyers are in control, steadily pushing the market upward. The price typically breaks previous highs while protecting the lows. So, during an uptrend, your main focus should be on buying. The uptrend remains intact as long as the most recent low holds. Once sellers gain momentum and the price breaks below that low, the trend is considered broken. For example, if price breaks this key low right here, the uptrend could be over. Now, the exact opposite applies to a downtrend. In a downtrend, price forms lower lows and lower highs. This time, sellers are in control, pushing price down by breaking previous lows while holding the highs. During a downtrend, your focus should be on selling. The downtrend ends only when buyers regain control and price finally breaks above the most recent high to the upside. Now, you might be wondering, why is identifying the trend direction so important in trading? Well, there's a reason traders say, the trend is your friend. One of the golden rules in trading is to avoid going against the market's dominant trend. And that's exactly why recognizing the overall trend is crucial. It helps you stay on the right side of the market and avoid unnecessary losses. But what if it's not clear whether the market is trending up or down? That usually means the price is in a consolidation phase, also known as a ranging or sideways market. This happens when the market takes a temporary pause to gather liquidity and decide its next move, either to continue in the same direction or to reverse once the battle between buyers and sellers reaches a tipping point. At this point, you could technically buy or sell, but the smarter move is to stay out of the market and simply just observe. Why? Because this is when most manipulations happen, and if you're not careful, there's a high chance you'll get trapped. The second hack on the checklist is identifying valid pullbacks on the chart. So let's break down exactly how to do that. First, you need to be able to recognize candlestick-based uptrends and downtrends. A candlestick uptrend is identified when the price consistently prints bullish candles, with each one breaking the high of the previous candle. This pattern shows strong upward momentum. But there's one more thing. For a bullish, impulsive move to remain valid, the lowest point of each candle should be equal to or higher than the one before it. This confirms that bearish pressure is limited, and the trend is still strong to the upside. The exact opposite applies in a bearish scenario. A candlestick-based downtrend is formed when the price prints a series of bearish candles, with each one breaking the low of the previous candle, showing strong downward momentum. For a single bearish impulsive move to remain valid, the highest point of each candle should be equal to or lower than the one before it. This indicates that bullish pressure is limited, and the overall trend remains clearly bearish. In a bullish scenario, A valid pullback occurs when a candle breaks below the lowest point of the previous candle, effectively sweeping its liquidity. For example, here, this last red candle dips below the low of the third green candle, confirming a valid pullback. However, if the price fails to break below the low of the last green candle, then it's not a valid pullback. Also, remember, the color of the candle doesn't matter when identifying pullbacks. What matters is the structure. Likewise, in a bearish scenario, a valid pullback forms when the price breaks above the highest point of the previous candles. Now, let's look at more examples to solidify your understanding of how valid pullbacks actually form on the chart. But before we continue, if you want to get a funded account quickly, check out Funded Next's new Stellar Instant Plan, which does not require a challenge phase. That's right, you get instant access to trading capital from day one. There is no daily drawdown limit, no minimum trading days, and you can withdraw profits anytime. The best part? Make just 10% and Funded Next doubles your account. They also offer plenty of other plans, ranging from $5,000 to $200,000 accounts. And finally, some of the best offers if you are a futures trader. If that's something you're interested in, check out the link in the description. Consider a series of bullish candles, as shown here. After forming 3 consecutive bullish candles, the price enters a temporary pause, indicated by 3 consecutive bearish candles, before pushing upward again. Now, as we discussed earlier, in a bullish scenario, a valid pullback must occur only if the price breaks below the lowest point of the last bullish candle before the bearish pause. However, in this case, none of the bearish candles broke the low of that last bullish candle, or swept its liquidity. Therefore, this sequence does not qualify as a valid pullback. Instead, we classify it as part of a bullish single impulsive move. In a similar example, take a look at the second candle series. After forming several strong bullish candles, the market pauses with a single bearish candle. But notice, this bearish candle doesn't break the low of any previous candle in the sequence, so it doesn't count as a valid pullback either. Now, here's where it gets interesting. If that bearish candle forms an equal high with the last bullish candle, and the next candle breaks below its low sweeping liquidity, then we do have a valid pullback. In this case, we've got a bullish impulse wave, a clear correction, and then a solid bullish continuation move. Now, the next hack on our list is understanding the different types of price behavior from the market structure perspective. Price movement is made up of 3 main sub-movements: impulse, corrective, and continuation. And each of these is formed by internal candlestick patterns. So, let's break each one down, starting with impulse moves. Impulse movements are strong, directional pushes in the dominant trend. They show up when price moves decisively, either pushing fast in a bullish move or dropping hard in a bearish one. This phase is usually driven by strong market sentiment and clear control by either buyers or sellers. For example, take a look at this bullish series of candles. We can see price pushing upward through a series of smaller impulses and corrective moves. These form the internal structure of what we consider a single bullish impulse leg. Why do we treat it as one unified move? Because along this entire path, price hasn't taken out, or even swept, the liquidity beneath any of the previous internal lows. That's the key detail that keeps this entire leg classified as a clean, uninterrupted bullish impulse. Now, from the candlestick perspective, we identify this internal movement as our impulse leg. Then comes a valid pullback, confirmed by this red bearish candle that breaks and closes below the previous bullish candle. This marks our minor correction. Next, price forms another bullish impulse, which we refer to as a minor continuation. We see this pattern repeat consistently: impulse, correction, continuation, until price reaches this swing high and finally begins a deeper corrective phase. Now let's move on to the corrective movement. A corrective move is essentially a countertrend or retracement phase that temporarily goes against the main price direction. We identify a correction when price breaks below the most recent pullback or internal low, or sweeps its liquidity using a candle's shadow. In this example, we can see 3 red candles forming the correction, clearly breaking and sweeping the low of the previous pullback. After that, price resumes its upward movement and eventually breaks above the latest swing high. This marks the start of the continuation phase. However, in this scenario, if price doesn't break the most recent pullback or internal low and instead continues pushing to the upside, then we don't have a valid corrective movement. So this price action should be considered a single impulsive move without any correction. It's important to remember that these principles work across all time frames and on any price action-based chart. Now let's move on to the next and final hack on our checklist, one of the most important and crucial elements, the market structure shift. Let's say the higher time frame market profile is bearish, as price has been forming a series of lower lows and lower highs through successive impulse and corrective legs. Now, if we zoom into the most recent retracement or corrective leg on a lower time frame, we can see that price begins to form a short-term bullish market structure like this. So, during this retracement leg, what we need to do is wait for price to reach a key higher time frame resistance area, or supply zone, and show signs of rejection. This resistance level could be a bearish fair value gap, an order block, a bearish breaker, or a mitigation block. If the price then breaks below the most recent pullback that formed just before the resistance level, it creates a market structure shift on the lower time frame. This shift signals that the temporary bullish trend is likely ending and that bearish momentum is returning. At this point, price is expected to realign with the higher time frame's dominant bearish trend. And it's important to note that for a market structure shift to be valid, we need a clear break and close below the swing low of the most recent pullback. Just a wick penetration isn't enough. Price must close below that level to confirm the shift. Now, you might be wondering, how can we tell if this bearish move is a true structure shift, and not just a typical bearish correction before the next leg up? Well, the key reason we treat this corrective move as a market structure shift is because price tapped into an unmitigated resistance level, such as a supply zone, fair value gap, or breaker, and then reversed sharply from that area. It's important to note, not every corrective leg qualifies as a market structure shift. For it to be valid, the move must originate from a key, unmitigated level on the higher time frame. This is why a deep understanding of market structure is essential. Without it, you're more likely to misread the chart and take unnecessary losses. Now, once the bearish market structure is confirmed, and we expect price to move lower, the next step is to look for a selling opportunity. At this point, you'll want to identify a bearish fair value gap, order block, or inversed fair value gap, formed within the structure shift leg. These areas often act as magnetic zones, where price is likely to retrace before continuing downward. In this case, you'd place a sell limit order and look to target the nearest liquidity pool on the current time frame, or aim for higher time frame key levels if you're going for a larger move. That's it, traders. Thanks for watching. I hope you found this video valuable. If you did, hit subscribe and turn on notifications so you never miss an update. Drop a comment below with your thoughts or topics you'd like to see next. Your support means the world to us. See you in the next video.